Good morning, everyone. Thanks for being here. I'd like to thank Mike and Matt for letting me moderate this panel and for loading it with folks here, so I'm not going to have to do much work. But I did see a couple of other bankers out there. So if anybody else wants to join, there's probably room. We got some extra seats. Grab some more folks. And of course, I want to thank Jim for his vision and for bringing us all together. As always, I was trying to think of a time when I saw Jim without a smile on his face, but I couldn't. So thanks, Jim. So I'm going to quickly run through who we got on the panel here, and then we'll just jump right in. And I'd ask everybody to just chime in with a panel this large, just speak your mind, hopefully give us some, insights into what you're doing and, what you think the future is. But, I'll kick this off, but I figure with this group, like I said, not much for me to do. So we've got Tanja Georg from KfW, Remco Jongkind from ABN AMRO, Christos Tsakonas from DNB, Ilias Katsoulis from Deutsche Bank, Vassilios Maroulis from Citi, Gaurav Moolwaney from Standard Chartered, and Cesar Z from CMB Financial Leasing. So my first question is just, there are over 900 delegates, so congratulations, Mike and Matt. And we've got 7 bankers on this panel. Is that because we're all so busy we want to come out here and brag about it, or is it because we're all looking for something to do?
Am I starting?
We'll start with you. Why not, Tanja?
Maybe it's both. I think we're all busy, and I think maybe it's a good sign to see so many banks up here to show that, we are in for business. I work at KfW IPEX-Bank, a German bank, been active in ship finance for many decades, and I think we've also belonged to the biggest ship financing banks for many years. So we are more of a specialized bank, focus on supporting the European shipping projects, European ship owners, European supplies to vessels. And that's what we've been doing for many years and want to continue doing. And I think our customers value that we are a long-term lender and know what we talk about, have the market knowledge, and so we're still up for business.
Remco, go ahead.
What I think is interesting, Mike, is that despite what's happening in the world, despite all the new wars, whether it's trade war or a new conflict in the Middle East, the panel is increasing in terms of number of bankers willing to provide money, which gives the wrong signal, I think.
I thought maybe the president's policies were just stirring tourism and people wanted to visit, but that's probably not it. Remco, your thoughts?
Yeah, we had a very busy first half of the year, firing on all cylinders. We operate our shipping group out of Oslo, Greece, and Amsterdam, and also including, let's say, the international ship owners that have a presence in Europe but are domiciled or based outside Europe. So we have a rather large scope of coverage, and as I mentioned, it has been a very busy first half of the year with a lot of volatility, as of course everyone knows. But we're open for business, and we are expecting something similar for the second half this year.
Similarly busy? Is it new deals, old deals?
A mix of both. I think there's always enough going on in shipping to keep everybody busy. But I think we have seen a little bit of slowdown in deal volume. I think if you look at the statistics and the numbers, there has been a slowdown. But there is still enough to do for everybody. And I think all the banks, and I'm sure everybody on this panel is generally looking after a set of names that everybody wants to go after. So for that, the situation has not changed. But the numbers show that the volumes are down. We haven't really seen it from what we do. And we're expecting H2 to be quite busy as well.
Christos.
I mean, there is no doubt that volumes are down. Most of the business that we do are refinancings. In our case, we do a lot of M&A advisory, so we do have facilities tied to that. But, the new buildings, thankfully, are not, at the high level that you would have expected to see because of technological uncertainty. And despite Basel IV and despite increases in cost of capital for banks, we do see pricing coming down, at least for stronger owners. And that is because, you know, as you said, people are competing basically for the same projects. So that's the reality that we see in ship financing today. And you mentioned the wars. I mean, these wars and uncertainty in general is sadly a net positive for shipping. And I think, you know, people see this, they recognize this, and that's why you see banks willing and keen to finance shipping projects, even in the current environment of uncertainty.
I'll echo what Christos is saying and everyone else. I think if I can summarize 25 so far, I think it started off in an extremely strong and optimistic way. And there have been quite a few events, whether it's Liberation Day or whether it is, that have created uncertainty and therefore some pause in some projects. I think the activity, if one looks at it, even though theoretically the portfolios are standing still to a certain extent, but that is being done through an unbelievable effort given the level of prepayments and amortization a portfolio has. I think for us, in terms of what we are doing, is we are targeting very large situations and transactions that we are leading also on the episodic side. We are being even more targeted and more selective, and ultimately there to provide very significant capital positions to assist in the process and ultimately the process. So ultimately, are we competing, and I think it goes for many of the panelists here, are we competing on single vessel financing? Are we going to be going down the path of trying to get to the lowest margin to prove that this is, you know, we are the best in that way? That's not what we're going to do. Have no interest whatsoever in doing that. There are many banks out there that are doing it. So, but in terms of our strategy is targeted, large situations, and going for ultimately max impact.
And if I may, I mean, I think you're absolutely right. And pricing is one thing. I mean, people are competing on pricing. But also now people are competing on structure. Yeah. And that is very, very dangerous at the current level of asset prices. You know, the markets will correct. And if you've given up solid credit structures that, you know, over years have protected you from the downside, that is the really dangerous part. Whether you price 5, 10 basis points lower, yes, that's not a game we want to play either, but it doesn't wipe you out of the map. Most banks are getting out of business because they're losing a lot of money in a down cycle, either because of bad client selection or bad structures, and that is what we are starting to see now, structures becoming much, much looser.
I still remember 10 years ago when I joined the CMB Financial Leasing, we are just a little potato in this shipping industry. But after the decades work, we are right now achieve a portfolio of 10 billion US dollar, which makes us ranked 10th in globally. And I'm very privileged to sit here with the experts from all the top tier players to discuss the future of the ship financing right now. We are, how to say, we would like to keep the momentum to going forward in the future. And currently speaking, we see the momentum is very, very strong because we enjoyed 3 billion drawdown last year, and we hold plenty of commission in hand. And the momentum is very, very obvious to going forward for the next few years. So we are very confident in the future.
So the threat of the impending tariffs isn't impacting your ability to get deals done?
We don't think that, just like Charlie Chaplin said, that the life is a tragedy in shortcut, but comedy in long shot. If we sit back visually on the situation, it will automatically become funnier. For the section 3301, maybe a lot of people talk this topic to us. Maybe a lot of people think that will be an issue to us, but frankly speaking, we are growing under the background, because from the Trade Act 1974, the investigating began. There were almost 120 times of the action. So let's do a math. From 1974 to this year, maybe 50 years. So it's twice a year, almost twice a year. So this is our background. This is where we come from. So our portfolio, our diversification is our bedrock of our company's philosophy. We get fully prepared for the worst scenario to take into stride.
Go ahead, Ilias.
So I was here last year along with some of the people, and I was feeling really good about myself, about the next 12 years in this business. I think, to be transparent, this year I feel a bit more cautious. I'm still optimistic, and in practice, we've actually deployed this year more in the first half than we did the same time last year. The way we do it is, we've kind of diversified the business model a bit. We don't take kind of concentrated exposure in one sector, and we're super careful with asset selection, client selection, and so on. All the good things that bankers should be doing, we do it in a more enhanced and concentrated fashion. So at least from Deutsche Bank side, we would love to do more business, but we don't want to compete on pricing. We don't feel like shipping is a market, given how volatile it is, where you need to race to the bottom. But would like to find fair price that reflects the credit risks involved. So we've been fairly successful in doing that, I feel, and particularly here in the US, where we've done quite a bit of business in the last kind of couple of years, and we'll hopefully continue to doing so.
Are any of the others of you seeing owners calling, trying to unwind sale-leaseback transactions? We're getting a lot of panicked phone calls. What do we do? And no one obviously knows what's going to happen, because it can change tomorrow and then change again the next day. But are you getting calls? Hey, how do we unwind these?
Absolutely. I mean, owners seem to be very concerned about the Chinese component of their fleets, be it Chinese-built ships, certainly Chinese-owned ships, and certainly Chinese-leased vessels. And I know that leasing houses are trying to develop various structures to get people comfortable. But I would say, the bigger, the strongest owners tend to steer more towards safety. So we do see quite a lot of people coming to us trying to refinance very competitive leasing structures that they have in place. Yes.
Yeah, I think you need to sort of, both for the tariffs and for USTR 301 and for the exposure on the Chinese leases, sort of analyze and understand what it is that people are trying to solve for. For the Chinese leases, I think you have vessels that were either Japanese or South Korean built, which are ultimately financed by leases. Those are being taken out, I would say, for the whole of our clients and portfolios almost immediately, proceeding immediately to go. They just don't want to deal with that element. Then you have Chinese-owned vessels, Chinese-built vessels, which are either financed, so the vessels are what they are. So if they make a US port call, either you're going to be exempt or you're going to be charged. So, but ultimately, do I take on how I decide to fund my capital structure, the additional port fee? And it's incredibly important how that will be applied, and how, of course, the charter is drafted as to who it is that will be taking on that additional cost. And then last but not least, the Chinese owned. So therefore, then you have to decide, where does it go? Is it going to be exempt? And of course, what will your charter decide to say? We've seen situations in which vessels which on paper clearly indicate that they're going to be exempt, but the charter is saying, I'm not taking that risk. You have to address it. So it's a bit of a, I think the discussions start, I want to be able to maximize my capacity and see how many I refinance. But ultimately, where it's going to land, it depends. You're seeing already shifts from the US administration. What I think is important on 301 is it's not a current US administration point. It comes from the previous one. It seems to be a one where I think there is support from both sides. So therefore, I don't see it disappearing, maybe amending. And then last, very brief on tariffs, you have to analyze it. The headlines are all there, but at the same point in time, we've done a full deep dive, and the actual seaborne goods that are being impacted, it's close to 5%. So, the headline's there, but is it really impacting?
Maybe I can make one point on that. When we look at this market or more Chinese vessels that potentially come to us for refinances, our risk people will also look at our portfolio. How many Chinese-built vessels, for example, do we have in our portfolio? So we are looking at those transactions, but from a wider portfolio perspective, we're also looking at the balance of, let's say, vessels built in different countries. So that's another factor that's taken into this decision making, if we can do it or not.
If I can play moderator for a second, because you gave a very interesting analysis of people's decision thinking decision matrix when it comes to Chinese ships. What we do see is that leasing houses are countering by making their terms even more competitive. Do you think there comes a point where people say, okay, I'm willing to take the risk because the financing is so competitive that I'm going to take it? Or you think it's really binary? If you have a Japanese ship, or if you have a Korean ship, you just want to disassociate it completely. How do you see it? Because that's what we are trying to figure out.
At the moment, what we are seeing is charters effectively saying, no. I don't want to get into. I understand that you're exempt. I don't want to get into that discussion, especially those that are, sort of like very closely associated with projects in the US. I think also we are seeing owners not really wanting to take that risk, and ultimately the delta between Chinese-owned, Chinese built is so significant that I think people are at the moment at least, calculating, all the elements of the potential refis, and for the time being, proceeding full throttle.
Yes, the other interesting thing is whether there's enough debt capacity in the European market to actually take out some of that exposure. And I guess, at least from our perspective, Deutsche Bank's perspective, we would welcome to, I don't comment whether we should, but we would welcome take out some of that exposure, because I think a lot of the business that Chinese lessors did was good business, actually, with good counterparties. And in that respect, we'd love to take some market share. Sorry.
Any insight on how the owners are making up for the advance shortfalls? Kind of following up on what you said, Christos, right? Like the advance rates are much higher. And the banks, I mean, through my career, I've seen the markets go up and banks advance 90%. And then when the market goes down, they advance 60%, kind of counterintuitive. But how are the owners making up for the shortfall, to get out of the leases? Are they just sitting on cash? Go ahead, Gaurav.
Yeah, so I think this started before that already, right? So it's not the last 3 months. I think we've already seen the advance rates have come off because the owners are sitting on a lot of cash. So it's no longer, if you dial back 5 or 10 years ago, you'd be haggling over 85 versus 75, but now an owner will come and say 65, right? Because they don't need the extra leverage. And that's also been driving a lot of the Chinese leasing refinancing, because they don't need that leverage, they don't want to pay for it. So we've already seen that trend, and I do think that the advance rates now, and touching a little bit on what you said, the structures have been generally reasonable, owners have been conservative, or most of them, and we're really hoping this stays, because then you go into dangerous territory if you start loosening up on the credit side.
Owners have a lot of cash at the moment. I mean, the typical capital structure is, 30% leverage. We haven't seen that before, and banks, there's a lot of capital to finance shipping. Banks are very active. We said before we are competing with each other, but you have a lot of European leasing vehicles that have been set up. I see Harris sitting there rubbing his hands as we talk about Chinese leasing becoming less popular. So there is a lot of capital to finance good projects. And the equity portion, people are flush with cash.
I think the ship financing banks are used to it being a cyclical industry. We know this, and we try to adapt to what the current demand is. And while we see lower advance rates, what we see at KfW is customers asking for more flexible financing structures, like going into RCFs to manage their liquidity more flexible, and we're trying to come up with financing solutions for those demands as well.
I think you're seeing it's a mix and match depending on the project and the owner. So you're seeing in some situations it may be the same owner that would say, look, for this project it's very high capex, let's say. I want to maximize my leverage. And in other situations he would say, look, I don't need that for this specific asset class. At the same point in time, I think as an institution for us, LTV is irrelevant. It's about the cash flow. It's about the corporate. 10%, LTV would not be of interest for a client that ultimately doesn't have the appropriate structure, doesn't have the appropriate cash flow generation. But it's a mix and match at the moment.
We'll move on from that one. So, just generally, what regions are you looking to finance, and what kinds of vessels, right? What's most attractive to you guys right now, kind of in the market? Are tankers attractive? Are you, what types of vessels, what industries? Is wind attractive? Offshore, are you willing to do offshore, or do you have, ESG restrictions around that? And then, we had a whole day on Jones Act yesterday, which was fantastic. Is Jones Act attractive? I mean, we'll start down there.
Well, I guess for us it is. We've done quite a bit of business in that market, and would love to do a bit more, by the way. Same as with kind of US flag. So yesterday's session was also very, very interesting. But as I was saying before, for us it's important to build a diversified business. I think that's good for our clients because it means that we're not exposed in any given sector, and therefore we can withstand market downturns. It's shipping after all. But right now we are kind of very active in kind of the Jones Act US space. But we're also very active in the commoditized shipping. We've done a lot of business in the offshore space as well, echoing some of the remarks made in one of the previous panels. We do like to do business where there's not too much banking competition, so I'd like to not compete with all these people here, but have a few of them. But at the same time, it's inevitable that if you are in ship finance, you have to finance the bigger credit-worthy players as well, and we do that as well.
We rode two waves of opportunity in the past 10 years. One is the container fleet booming before the COVID. Another is the LNG fleet update after the pandemic. So we take the chance and make a great improvement. And in the future, we think the green update and the decarbonization update is the trend. We have to follow this trend. And in our company, that we built a model based on deep study on the correlation between the different type of vessels, which guide our development activity. So when we enjoy the fast growth in the past time, we also very carefully to make the balance of our portfolio. Until now, we are quite proud that we have achieved our portfolio, which includes bulk, tanker, container, 20% each, and gas 30%, about 30%, and the others specialized types of vessel, including PCTC, cruise, or something like that, less than 10%. So a well-balanced, a very healthy portfolio, so we can face any scenario. We will follow this philosophy, follow this bedrock, as I just mentioned, to going forward.
And maybe to connect to that, We're also looking at the diversified portfolio. Effectively in all asset classes, with the exception of cruise, which we see more as leisure than shipping business. So that's one that's excluded. But back to the, let's say, portfolio strategy, it's not only diversification in asset classes, we're also looking at, from the ESG perspective, how do those vessels fit in our portfolio in the next 5 to 10 years in terms of emissions, and what kind of cost will be related to that, and what kind of investments are required to maintain, let's say, the various climate strategies that are required. So from an asset perspective, that's just one element, let's say, in terms of diversification, but there are a couple of other lenses, if you like, including the return metrics, of course, that you need to meet. Also, let's say, certain vessels with dual fuel, for example, with the optionality to go either left or right, what Anders just mentioned. He's long on oil very clearly and less bullish on certain alternative fuels. All those kind of metrics you need to factor into your decision making in terms of what type of asset classes you take in.
Anyone else want to chime in?
I think it's very hard to always answer this question about which asset do you prefer, right? Is it your tanker or bulk or LNG? What's the flavor? I think it's very hard to pick your sort of favorite child there, but I think we always looked at everything with the dual lens of corporate and asset. And I think if you go back over the last few years, if you leaned too heavily on one versus the other, it would generally not end up very well. So you always have to keep that balance right, where you're not just doing something because you love the corporate and you'll ignore the asset or vice versa. And as long as you keep that balance, and then of course, I mean, we mentioned it before, keep the book diversified.
Just wanted to add, I agree. We also want a diversified portfolio along our mandate. So we are also looking for future-proof vessels and select the financings according to what the vessel will, how it will perform and how it contributes to decarbonization. And at IPEX, we've been a long financier of cruise vessels, so that's kind of complementary to what you said. We have a very big cruise portfolio, and we see that the cruise business has picked up again. It's at the same levels as it was pre-COVID, and there's a lot to finance there for us.
How does the fuel source impact pricing? Are you giving better pricing for dual fuels? Are you leaning more? Is the ESG influence of the banks, is it causing you to look towards LNG powered fleets? And based upon the last panel, it's going to be bunker fuel forever, but 10 minutes earlier it was going to be nuclear. Would you finance a nuclear powered ship?
I'll make a start. Look, at the end of the day, we are not there to decide what our clients will opt for, right? For each and every propulsion system, we will be analyzing the impact in our portfolio. So whether it is heavy fuel with scrubbers, low sulfur, ammonia, methanol, there are elements to each and every one that one needs to analyze. What is the impact to the portfolio? Where do you want to take the portfolio? Do you want to have a mix and proceed accordingly? Is there a delta in pricing? I don't think so. Maybe there would be for older vessels, for ones on heavy fuel. There you would say, so I can't, at the moment, it's not a reduction of margin or pricing because you're going into an ammonia-powered vessel. It's rather all the technology having, at least as far as I'm concerned, in terms of my decision-making, for those older, let's call it, or more traditional, or however you want to call it. Financing nuclear-powered vessel, yeah, we would do it absolutely with the appropriate analysis, and the same goes, I think the same analysis that we would do, by the way, for nuclear, we would do for ammonia, especially, because you have to take into consideration how potentially dangerous the bunkering operations are with regards to an ammonia-powered vessel. So appropriate analysis that are ultimately for us to be convinced by our clients, because we're not deciding. We expect our clients to tell us, this is what we're doing, this is why we're doing it, and by the way, this is why you need to be comfortable with our decision.
Yeah, I mean, what we really want to see is that clients are aware that the transition is taking place. That is important. What we also want to see is that people are managing their emissions in the best possible way, in the sense of retrofitting existing ships with the best technologies available to try and improve their environmental footprint. Older ships, yes, they're becoming more challenging. You know, if you have a 20-year-old ship, a 15-year-old ship, it's more difficult to justify keeping it in the portfolio. But of course, as part of a company's transition plan, they need to have older ships, you know, in the fleet. And one could argue that an older ship has less risk when it comes to transition because it will be scrapped in 5 or 6 years. So we absolutely want to see people improving the efficiency of fleets on the water. When it comes now to specific technologies, you know, we don't really push, and we take guidance, you know, from our clients. I mean, from a risk perspective, you know, you could argue there ought to be a premium on new technologies because they're untested, but that's not what is happening in the market. But most of our clients, you know, all of the clients in the portfolio have a very mature approach when it comes to transition and the adaptation of new technologies.
I was going to say something similar. I mean, we're also very open-minded when it comes to this type of thing. I mean, we can't distinguish right now and put a certain price into a certain fuel. But echoing what Vassili and Christos said, we're looking at every transaction, and we're very, very happy to kind of analyze it and understand the merits of it. But clearly, the world is moving towards the, you know, including ourselves, kind of monitoring the portfolio and moving towards a world where we want to see cleaner vessels. And I think that trend hasn't stopped, despite what's been happening over the last kind of few months in the world, basically.
And maybe I can add one point to that. We are looking for solutions for our clients. So with regards to emissions, for example, we started up our carbon banking offering. So clients can hedge, let's say, their carbon exposures. They can buy forwards. So the oil element and the emission element is there to stay. So we're looking also at solutions for clients that need to hedge those exposures.
I'm going to change subjects here into another topical matter, though. Anybody using AI, you know, in their credit decision-making process or monitoring their portfolio?
We all want to keep our jobs, Mike.
Well, I think it's the younger people, Ilias. I think we're fine.
I mean, we're actually not specifically using it, but it's been introduced as a tool. I think it's kind of coming into our lives as well. But at the moment, it's not as prevalent. We are taking baby steps into it. But clearly, it's just moving really fast for us as well.
Anyone else?
Yeah, it's being used as a tool in the bank, that's for sure. And, you know, undoubtedly, I mean, consistent with how we use it. You know, a year ago, I would never use, you know, now you use it in some things. It's actually quite useful in summarizing stuff. It's incredibly powerful, and undoubtedly, you know, will be used significantly more as its capabilities, you know, it's exponential.
Yeah, for credit analysis, for financial analysis, there is a lot that can be done. We have a number of pilots in the bank. People are using it. But more can be done, and I think, you know, the future credit papers or, you know, credit analysis will be very heavily reliant on AI. I think there is a lot of efficiencies that can be taken out there, but we do use AI a lot on the commercial side and the retail side of the bank. So it's coming, yes.
All right. Changing topics again here. So, are the big syndicated deals still there? Are they alive? And if they are, how are you guys dealing with kind of the different, you know, sanctions, ESG requirements of the different countries and the different banks? I mean, I know in one transaction we're doing now, you know, you're pretty much across the finish line, and then you get, you know, the sanctions riders from 6 different banks, and sometimes they conflict. How are you guys dealing with that?
Yeah, I think we're all in the same situation as banks or as a syndicate. So same with regulations, other regulations, IMO, etc. So it's just another regulation we need to take into account. I don't think, or at least from what I see, there's a big deviation in between banks regarding all those items. So it's more equal level playing field, I would say. And if it comes in, we're all faced with it at the same time.
We try to find good lawyers, Mike, who can bring everything together and harmonize it.
That helps. All right, we'll wrap up with this one. Where do you guys see this going in the next 3 to 5 years? Are there going to be structural shifts? Is it going to be business as usual? Are there going to be changes to the way bank finance is done, or is this are we all safe? Maybe is the question.
I think the one shift that we will see will be from Basel IV. And I think we were going to see that come. I think different banks have started moving. The European banks moved. We are a British regulated bank. We move in 27. There will be an impact. It's not doomsday from where we see it, but I don't think we could just ignore that nothing will happen, right? So like for like, all other things being equal, the capital you have to put up for a shipping deal has to go up, in most cases, from where it was. Now, from a borrower perspective, does that mean that you're going to have to price up or banks are going to disappear? Not necessarily, because I'm only talking about the supply side of money. As long as the demand side is where it is, that competition will keep it healthy. But we do think that the type of deals we do, the type of clients we support, and where we choose to deploy capital will evolve. And this will change, and we're not seeing that impact today. But I do think in 12, 18, 24 months, big banks who will get impacted will pivot their strategies accordingly.
Anybody else want to jump in on that one? Go ahead.
I personally hope that the decarbonization will be a momentum, a goal that is pursued. And I think for banks to continue to support this, we need global regulations that force the ship owners to go in that direction. And I would also like to see that there's maybe incentives from governments or the EU to specifically provide finance for these projects.
I have a feeling that might be a challenge here in the States in the next few years.
Just as I said, we are not aiming to be the biggest one. This is not our goal, but we are searching for to be sustainable health and well-balanced growth. As I said, the green upgrade is the trend. We must follow that as a banker. So we are developing and discussing with our clients with some, how to say, the CII-linked charter hire or tenor mechanism to support their upgrade on the decarbonization. So this is what we should do and we will do in the future.
All right, that's it. Thanks, everybody. I appreciate your time.
Thank you, Mike. Thank you, Big Ticket Ship Finance Summit. We heard earlier today about 1 + 1 making 3. And we'll see a perfect example of that in action with ADNOC's acquisition of Navigate. I'd like to call up our next panelists, Nicholas Gleason, Jason Klopfer, and our discussion leader, Doug Mavernack. bit of room.
All right, everyone. We're going to get started with our next session of the day.